What sets Warren Buffett apart from other investors? How has he been able to consistently outperform the market and build such incredible wealth? The answer lies in his investing philosophy and the set of rules he's developed over decades of experience. In this video, we're going to dive deep into the top 7 investing rules of Warren Buffett. From the importance of preserving capital to the value of investing in what you understand, we'll explore the key principles that have made Buffett so successful. Whether you're a seasoned investor or just getting started, these rules will provide invaluable insights into how to invest wisely and achieve long-term success in the stock market. So keep watching because Warren Buffett's top 7 investing principles are about to be revealed. Let's dive into it. Rule number 1. Never lose money. Warren Buffett's philosophy on investing is to focus on preserving capital first and foremost. His reasoning is simple. If you lose 50% of your money, you need to make a 100% return just to get back to even. Losing money can set you back significantly, and therefore it's crucial to avoid it as much as possible. Buffett's approach to this rule is twofold. Firstly, he avoids risky investments that could potentially result in significant losses. He's famously quoted saying, "Rule number 1, never lose money. Rule number 2, never forget rule number 1. Secondly, he employs a margin of safety in his investments. He looks for companies with strong fundamentals, consistent earnings, and a durable competitive advantage, all at a reasonable price. He seeks to buy businesses that have a large moat that protects them from competition and provides them with a sustainable advantage over time. This approach ensures that his investments have a margin of safety, which means that even if the market drops, the underlying business is strong enough to withstand it. By sticking to this approach, Buffett has been able to avoid significant losses in the past and has consistently outperformed the market over the long term. In conclusion, Warren Buffett's rule of never losing money highlights the importance of capital preservation in investing. It's crucial to avoid risky investments and seek a margin of safety by investing in companies with strong fundamentals and a durable competitive advantage. By following this approach, investors can protect their capital and achieve long-term success in the stock market. Rule number 2. Don't follow the herd. Warren Buffett is known for his contrarian approach to investing. He avoids following the herd mentality and instead looks for undervalued opportunities that others have overlooked. In fact, he often says, "Be fearful when others are greedy, and be greedy when others are fearful." This means that when the market's in a frenzy and everyone is buying a certain stock, Buffett will often stay away, as he believes it is overvalued. Conversely, when everyone is selling a particular stock, Buffett sees it as an opportunity to buy it at a lower price. One example of this contrarian approach is Buffett's investment in American Express. In the 1960s, American Express faced a crisis when it was revealed that a subsidiary was involved in fraudulent activities. The stock price plummeted and most investors sold their shares. However, Buffett saw an opportunity to buy the stock at a discounted price, as he believed the company would recover from the crisis. His investment paid off, and American Express became one of the most successful investments. Buffett's advice to not follow the herd applies not only to investing, but to other aspects of your life as well. It's easy to get caught up in trends and fads, but it's important to do your own research and make informed decisions rather than blindly following what everyone else is doing. In summary, Buffett's second rule of investing is to avoid the herd mentality and be a contrarian investor. Look for undervalued opportunities that others have overlooked and be willing to go against the crowd when necessary. Rule number 3. In Warren Buffett's investing principles is to invest in companies with a strong moat. In this context, a moat refers to a competitive advantage that a company has over its competitors that allows it to protect its market share and profitability over time. A company with a strong moat can fend off competition, maintain high profits, and generate good returns for its shareholders. A moat can be in the form of brand recognition, high switching costs, patents, network effects, economies of scale, or any other factor that gives a company a durable competitive advantage. For example, Coca-Cola has a strong brand that has been built over decades, and this makes it difficult for new competitors to enter the market and win market share. Similarly, Microsoft has a strong network effect in the operating system and productivity software markets, which makes it difficult for competitors to displace it from its dominant position. Warren Buffett believes that companies with a strong moat are more likely to have sustainable competitive advantages that can generate long-term returns for investors. When evaluating a company, he looks for the presence and durability of its moat, and whether the company can continue to defend its position in the face of competition and technological disruption. Of course, a company's moat is not the only factor that Buffett considers when making investment decisions, but it is an important one. By investing in companies with a strong moat, Buffett seeks to ensure that he is investing in businesses that can withstand the ups and downs of the market and deliver long-term value to shareholders. Rule number 4. Invest in what you understand. One of the key principles of Warren Buffett's investing strategy is to invest in what he understands. He famously says, "Never invest in a business you cannot understand." Buffett's approach is to invest in companies that have simple and understandable business models. He looks for businesses that have a sustainable competitive advantage, a strong management team, and a clear path to future growth. Buffett believes that by investing in what you understand, you will be able to make better investment decisions and avoid investing in companies with unclear or confusing business models. This approach has helped him to avoid investing in technology companies during the dot-com bubble, which ultimately resulted in huge losses for many investors. In addition to understanding the business model of the companies he invests in, Buffett also believes in understanding the broader economic landscape. He closely follows macroeconomic indicators and trends such as interest rates, inflation, and GDP growth to help inform his investment decisions. Overall, investing in what you understand requires discipline and patience. It means being willing to pass on opportunities that may seem attractive but are outside your circle of competence. By sticking to what you know and understand, you can increase your chances of making sound investment decisions that will yield long-term results. Now, before we move on, I'd like to remind you to subscribe to our channel for more investment tips and tricks. We post new videos every week that can help you make informed investment decisions and grow your portfolio. Now, let's get back to the video. Now, let's talk more about rule number 5, which is never invest in something you don't understand. Warren Buffett believes that you should only invest in businesses or industries that you understand. That means that before investing in stock, you should do your research and make sure you understand the company's business model, financials, and competitive landscape. You should also have a clear idea of the risk and potential rewards associated with the investment. Buffett has said, risk comes from not knowing what you're doing. He believes that investing in something you don't understand is not only risky, but also foolish. If you don't understand a company's business, you won't be able to make informed decisions about the investment, and you'll be more likely to panic and sell your shares during a market downturn. Buffett's investment philosophy is based on the idea of value investing, which involves buying stocks that are undervalued by the market. To identify undervalued stocks, he looks for companies with a strong competitive advantage, consistent earnings growth, and a high return on equity. Buffett also advises investors to stay away from complex financial instruments like derivatives and options, which can be difficult to understand and carry a high level of risk. He has famously said that derivatives are financial weapons of mass destruction. In summary, Rule 5 is about sticking to investment that you understand and avoid complex financial instruments. By doing your research and investing in businesses that you understand, you'll be more likely to make informed decisions and achieve long-term success. Rule number 6 of Warren Buffett's investing principles is to focus on long-term performance and ignore short-term market fluctuations. Buffett believes that the stock market is inherently unpredictable in the short term and that investors should not try to time the market or make decisions based on short-term fluctuations. Instead, Buffett recommends that investors focus on the long-term performance of the companies they invest in. He advises investors to look for companies with strong fundamentals and competitive advantages that are likely to generate consistent returns over the long term. Buffett often cites his investments in Coca-Cola and American Express as examples of this principle. Both companies have been in Buffett's portfolio for decades, and he has held on to them through multiple market cycles and fluctuations. Despite short-term ups and downs, both companies have generated consistent returns over the long term, making them valuable investments for Buffett. Buffett also cautions against the temptation to follow market trends or invest in popular stocks simply because they are in the news. Instead, He advises investors to do their own research and focus on companies with strong fundamentals that are likely to perform well over the long term, even if they may not be the most exciting investment in the short term. In summary, Rule 6 emphasizes the importance of focusing on the long-term performance of the companies in your investment portfolio and avoiding the temptation to make short-term decisions based on market fluctuations or trends. By staying focused on strong fundamentals and competitive advantages, investors can generate consistent returns over the long term and build a strong investment portfolio. Rule number 7 is to be patient and disciplined. Warren Buffett is known for being a long-term investor. He believes in holding on to his investment for the long haul, even if there are short-term fluctuations in the market. This is because he believes that over the long term, good companies will increase in value and provide solid returns for their shareholders. In addition, Buffett advises against trying to time the market or make short-term trades. He believes that this approach is more like gambling than investing and that the odds are not in the investor's favor. Instead, Buffett suggests that investors take a patient and disciplined approach to investing. This means doing thorough research on companies before investing and then holding on to these investments for the long term. It also means resisting the temptation to make impulsive decisions based on short-term market movements. One way to be patient and disciplined is to have a well-diversified portfolio. By investing in a variety of companies across different industries, investors can help reduce their overall risk and increase their chances of success over the long term. Overall, Rule 7 is a reminder that successful investing takes time, discipline, and patience. While it may not provide the instant gratification that some investors crave, a patient and disciplined approach is more likely to lead to long-term success and solid returns on investment. But what do you think? Are these principles something you would consider implementing in your own investing strategy? Now that you've learned about Warren Buffett's top 7 investing principles, let us know in the comments below if these were already standards that you used, or if you're going to integrate these principles into your investment approach. Remember, investing is a long-term game, and there are no shortcuts to success. If you're interested in learning more about investing, be sure to subscribe to our channel and hit the notification bell to get notified when we post new videos. We'll see you in the next video.